Now in this module, Module 50, we're going to be learning about efficiency and deadweight loss. I'll begin this module by defining total surplus in a market and then discuss its relevance to the efficiency of a market. Then I will explain how government taxes can have an effect on total surplus in the market and can actually lead to a concept that we've explored before, something called deadweight loss in the market. So let's begin by talking about consumer surplus. When you hear economists hailing the power of markets, they are typically alluding to the ability of markets to provide outcomes that are the most efficient to all other ways of organizing the exchange of goods. The total surplus that is generated in a market is the total net gain to both consumers and producers from trading in the market. It is the sum total of the producer and the consumer surplus. The concepts of consumer surplus and producer surplus can help us understand why markets are an effective way to organize economic activity because of their efficiency. Here is a graph that shows us visually what total surplus looks like. Remember that we said in the prior module that consumer surplus is the area of a triangle above the equilibrium price and below the demand curve, here shaded in blue. The area of producer surplus is the area below the equilibrium price and above the supply curve, shaded in the pink area here as producer surplus. If you sum the area of these two triangles, you form one giant triangle that is the area of total surplus in the market. Now, the previous graph shows that both consumers and producers are better off because there is a market for this good. We call this the gains from trade. Buyers and sellers are both better off, and there is a win-win situation when buyers that have a higher willingness to pay exchange and buy a good from a seller that has a lower cost to produce the item. These gains from trade are the reason everyone is better off participating in a market economy than they would be if each individual tried to be self-sufficient. So economists talk about gains from trade in the abstract, but anytime a consumer makes a purchase from a producer, a trade has been made and both parties expect to gain as a result of the trade. These gains are the concepts of consumer and producer surplus. So suppose we line up our buyers in descending order based upon their willingness to pay for gadgets, and we line up sellers in ascending order based upon their cost of producing gadgets. This is described in the table on this slide. Imagine that these 7 buyers and 7 sellers are allowed to meet in a room and negotiate prices for gadgets. Buyers will not pay a price that lies above their willingness to pay, and sellers will not accept a price that lies below their production cost. So how will this work? Buyer 1 and seller A should be able to find a price that allows both to walk away happy. Likewise, it would be fairly easy for buyer 2 and seller B to negotiate an acceptable price. However, it would be impossible for buyer 7 and seller G to negotiate a price that allows both to gain. A quick glance at the table shows us that 5 gadgets will be bought and sold, and the 5th transaction will be made at a price of $6. In a competitive market, the trades will be made at the price of $6. If that's the case, how much consumer and producer surplus has been earned? Well, let's revise the table to the one that you see here. If we sum the total consumer surplus, it will be equal to $10. If we sum the total producer surplus, it will be equal to $10. We add those together and there will be a total surplus in the market of $20. Now, it's important to keep in mind that it's only a coincidence here that consumer surplus and producer surplus are both equal to $10. They are not always equal to each other, and it's very important to keep that in mind. Don't assume that once you find consumer surplus, producer surplus will be the same. In this example it is, but in many examples, consumer surplus and producer surplus are different from each other. But total surplus will always be equal to the sum total of consumer and producer surplus. Now, if we were to smooth out the demand and supply curves from the tables that we looked at in the previous slide, we would see that at the market equilibrium price and quantity, Total surplus is the sum of the consumer surplus and the producer surplus triangles. This then begins to show us why markets are efficient. Okay? The claim in a market economy is that the maximum possible total surplus is achieved at market equilibrium. The market equilibrium allocates the consumption of the good among potential consumers and sales of the good among potential sellers in a way that achieves the highest possible gain to society. And any change from the market equilibrium will reduce the total surplus in the market. The market outcome for gadgets that was pictured in the previous slide is only one way to distribute the goods, but economists state that the market provides the most efficient outcome possible. Remember, a market is said to be efficient if, once the market has produced its gains from trade, there is no way to make some people better off without making other people worse off. But maybe there is a better way. Suppose a government minister was in charge of determining the purchase and sale of gadgets. Maybe this person could do a better job. Let's consider three approaches the minister could take. The minister could reallocate consumption among consumers by taking the good away from buyers who would have purchased the good in the market equilibrium and giving it to potential consumers who wouldn't have bought it in the equilibrium. Second, the government minister could reallocate sales among sellers by taking sales away from sellers who would have sold the good in the market equilibrium and instead compelling potential sellers who would not have sold the good in equilibrium to sell it. Finally, the government minister could change the quantity that is traded by compelling consumers and producers to transact either more or less than the equilibrium quantity. So let's look at the first approach, reallocating consumption among sellers. Well, in the above example that we looked at previously, buyer 1 had a willingness to pay of $10, but they get a gadget at the price of $6, and therefore they earn $4 of consumer surplus. Buyer 7, with a willingness to pay of $4, is not willing to pay $6, so they don't get a gadget. But suppose the minister decides that buyer 7 gets a gadget and buyer 1 does not. This is not efficient because it lowers the total consumer surplus. The lost consumer surplus equals $4 from buyer 1, who does not get to enjoy the gadget, plus buyer 7 actually has $4 minus $6, or negative $2 of gained surplus. So the total lost surplus is $4 plus $2, or $6. Now, that is shown in a different example here on this slide as a loss in consumer surplus if a book was sold and it was taken from Anna and given to Bob. Secondly, we could reallocate sales among sellers. If we did that, seller A, in the previous example, would be able to sell a gadget at $6 and earn $4 of producer surplus. Seller G could not sell his gadget because his cost of $8 exceeds the market price. But suppose the minister decides that seller G should be able to sell the gadget and seller A cannot. This is not efficient because it lowers the total producer surplus. The lost producer surplus is equal to $4 from seller A, who does not get to sell the gadget, plus seller G has actually $6 minus $8, or negative $2 of gained producer surplus. So the total lost producer surplus is equal to $4 plus $2, or $6. That is shown in this graph here, in the sale of a textbook, transferring the sale from Xavier and instead giving the sale to Yvonne. And you can see the lost producer surplus. The third thing that the minister could do would change the quantity traded. Maybe the minister believes that fewer or more than 5 gadgets should be traded. Well, only 3 gadgets should be traded at a price of $6. Then you have foregone consumer surplus from buyers 4 and 5 equaling $1 plus 0, or equal to $1. Foregone producer surplus from sellers D and E of $1 plus 0 equal to $1. And that plan would create a loss of $2 of total surplus. Now, 7 gadgets should be traded at a price of $6. You have the lost consumer surplus from buyers 6 and 7, which equals 5 minus $6, plus 4 minus $6 equal to negative $3. And a lost producer surplus from sellers F and G equals $6 minus 7, plus $6 minus $8, and that equals negative 3. So that plan creates a loss of $6 of total surplus. And that is shown in this graph here as a loss in the transaction between Anna and Xavier is prevented, and the loss in total surplus if the transaction between Yvonne and Bob is forced. So what have we discovered by this? Well, once a competitive market has reached equilibrium, there is no other way to increase the gains from trade. All of the above solutions, the 3 we just looked at, reduce total surplus, and therefore they all reduce market efficiency. So we can sum it up this way. An efficient market performs 4 important functions. Number 1, it allocates consumption of the good to the potential buyers who most value it, as indicated by the fact that they have the highest willingness to pay. It allocates sales to the potential sellers who most value the right to sell the good, as indicated by the fact that they have the lowest cost. 3, it ensures that every consumer who makes a purchase values the good more or equal to than every seller who makes a sale, so that all transactions are mutually beneficial for both parties. And 4, it ensures that every potential buyer who doesn't make a purchase values the good less than every potential seller who doesn't make a sale, so that no mutually beneficial transactions are missed. Now, it's important to remember that efficiency is just one outcome that we expect to see from markets. However, not all markets are efficient. In a later module, we will see that there are market failures, or what we call externalities, that can occur in markets. And it's also important to keep in mind that not all markets produce outcomes that are fair or equitable for buyers and sellers, however we define fairness or equity. So next, let's talk about those concepts of equity and efficiency in markets. What is considered fair or equitable depends on many factors. A market price of $6 for a gadget may seem completely fair to a person who can afford $6, but extremely unfair to a person who cannot. Most societies have found it desirable to sacrifice some efficiency in the market to gain a little equity or fairness for other people. The example that we use here of designated parking spaces that you find in your textbook for disabled persons is a great example of that. Okay? Designating handicapped parking spaces is not an efficient use of that space, but many people in society say, but that's fair for people who are disabled. So the market outcome of efficiency is not one that we desire. We desire more fairness than we do efficiency. Now, can you think of any goods or services that you think are priced unfairly high? What would you do about it? If you can't think of any examples yourself, remember the minimum wage is a price floor because the wage for unskilled labor is considered to be unfairly too low. As a matter of fact, we've seen many protests recently of people arguing for a $15 an hour minimum wage because they believe the current minimum wage is unfair to many workers. But if we increase the minimum wage, that would reduce market efficiency. Would you abolish the minimum wage to increase efficiency, or do you believe it's more important to lose some efficiency, a trade-off or an opportunity cost in the market, to gain more equity or fairness for those workers? Often, many of our economic and political debates that we have between conservatives and liberals and Republicans and Democrats, if you go down to the core or the essence of the debate, what you will find is it's a debate between efficiency and equity. And what we find is that conservatives and Republicans generally tend to favor efficiency over equity, whereas Democrats and liberals tend to value more equity over efficiency. Now, that doesn't mean that Republicans and conservatives don't like any equity at all. It just means they place greater value and emphasis on efficiency over equity, and vice versa for people that call themselves liberals and Democrats. It's not that they don't like efficiency at all in the market, they just tend to value equity outcomes a little bit more. So, at the root of our debate surrounding taxes, we often find debates about equity and efficiency. Most nations have a system of taxation that serves to redistribute some income from the wealthy in their society to the poor. Now, this may not be efficient, but these nations have decided they think it is fair. Economists classify three different types of taxes according to how they vary with the income of individuals. A tax that rises more than in proportion to income, so that high-income taxpayers pay a larger percentage of their income than low-income taxpayers, is called a progressive tax. A tax that rises less than in proportion to income, so that high-income taxpayers pay a smaller percentage of their income than low-income taxpayers, is called a regressive tax. And a tax that rises in proportion to income, so that all taxpayers pay the same percentage of their income, is a proportional tax. Now, one tax that is used in many countries is called an excise tax. An excise tax is a tax levied on each unit of a good that is sold. In the United States, excise taxes are imposed on the sale of goods, such as gasoline, tobacco, alcohol, and in many cities, hotel rooms. Excise taxes tend to raise the price that is paid by buyers for a good and reduce the price that is received by sellers. In effect, excise taxes drive a wedge between the buyer and the seller. Examples might include an excise tax levied on sales of taxi rides, or an excise tax levied on the purchase of taxi rides. So let's look at an example. Suppose the market for gasoline in Smog City is free of any taxes. The equilibrium price is $2 per gallon, and 1 million gallons are sold every day. The market for gasoline in Smog City is drawn here. For the sake of convenience, the supply curve begins at the origin. Now, if you wanted to look at an example with more math, the supply curve would be given as P equals 2 times the quantity supplied, and the demand curve would be given by P equals 5 minus 3 times the quantity demanded. The fact that the excise tax generates deadweight loss can be shown, however, without using these functions and the algebra behind them. Now, if we compute the total surplus as the combined area of the two triangles that we see here in the graph, we can compute it as consumer surplus is equal to 1/2 times $3 times 1 million, which would equal $1.5 million of consumer surplus, the area of the triangle above the equilibrium price of $2 and going up to the demand curve. Producer surplus is the area of the triangle below the equilibrium price and above the supply curve, and that's equal to 1/2 times $2 times 1 million, which would be equal to $1 million. So if we add those two together, 1 million plus $1.5 million, we get total surplus here of $2.5 million. Now, let's look at an example of an excise tax that is imposed on the sellers of gasoline. Politicians in Smog City decide to impose on gasoline sellers a $1 tax on every gallon of gasoline sold. For sellers, this means that to continue to sell 1 million gallons per day, they must receive $3 per gallon, because $1 must be sent to the government. In other words, the supply curve shifts upward by $1, the amount of the tax. After the tax, only 800,000 gallons of gasoline are exchanged, and the price paid by consumers at the pump has risen to $2.60. The price sellers actually receive is equal to $2.60 minus $1, the dollar paid in taxes, or $1.60, because they have to send their $1 to the government for every gallon that they sell. Thus, the tax creates a wedge between the price the buyers pay of $2.60 and the price sellers actually receive of $1.60. But who is really paying the tax? Consumers see a price that is 60 cents higher than before. Sellers receive, after the tax, a price that is 40 cents lower than before. So we can determine that consumers are paying 60 cents of a $1 tax, or 60% of it, and sellers are paying 40 cents, or 40% of the $1 tax. Now, let's look look at an example of an excise tax imposed on buyers. Politicians in Smog City decide to impose the $1 tax on gasoline buyers rather than on sellers. Buyers must pay $1 to the government for every gallon of gasoline that they purchase. This would lower consumer willingness to pay by $1 for each gallon purchase, which serves to shift the demand curve downward by the amount of the tax, or downward by $1. So, after the tax, 800,000 gallons of gasoline are exchanged. Sellers receive $1.60 for each gallon of gasoline sold, and buyers pay a total of $1.60 plus $1, or $2.60 for each gallon purchased. So again, the tax has created a wedge between the price received by the sellers and the price paid by the buyers. But now, who is paying the tax? Buyers are still paying 60%, and sellers are still paying 40% of a dollar tax. In other words, not much has really changed, whether the tax is imposed on the buyers or the tax is imposed on the sellers. This is referred to as the incidence of the tax. The incidence of the tax is looking at who really pays the tax. So if a tax of $1 is imposed on gasoline, how much of it is actually paid by buyers and how much is actually paid by sellers? In this case, whether it's imposed on the sellers or the buyers, 60 cents is paid by the buyers, so they bear 60% of the tax, and sellers bear 40 cents or 40% of the tax. That is the incidence of the tax. So in this case, the consumers have a slightly larger share of the tax than do the sellers. Now, is it always going to be this way? No, it won't always be that way. The incidence of the tax, or who really bears the burden of the tax, or who the tax is shifted onto, regardless of who the tax is imposed on, is different in every case. Now, what determines that? Well, now we go back to looking at the price elasticity of demand. This is where elasticity of demand comes back into play. Because the price elasticity of demand, whether it's elastic or inelastic, will determine who really bears the burden of the tax, whether it's more on the seller or more on the buyer. The incidence of a tax is a measure of who really pays it, and who really bears the tax burden does not depend on who officially pays the tax. The wedge between the demand price and the supply price becomes the government's tax revenue. So the tax incidence really depends upon the shape or the elasticity of the demand and the supply curves. This shape, steep versus flat, or vertical versus horizontal, depends upon the price elasticity of demand and the price elasticity of supply. So, in our first example, let's examine when an excise tax is paid mainly by consumers. In the Smog City example, the majority of the tax was paid by consumers, though it wasn't obvious why it worked out that way. So let's create another market to see how such a situation arises. If the tax of T dollars is imposed on the sellers, the supply curve will shift upward by T dollars, and the new price is P2. And it's nearly the entire amount of T dollars higher than the original price of P1. So if the demand curve is relatively inelastic, or closer to being vertical, and the supply curve is relatively elastic, or closer to being horizontal, the buyers will pay the larger share of the excise tax. Here you can see that here, with the tax burden falling mainly on consumers. Here, the supply curve is relatively horizontal. The excise tax is $1 per gallon of gasoline. So before, buyers were paying $2 for gasoline. Now they're paying $2.95, but because of the dollar tax, sellers only receive $1.95 for each gallon of gas sold. But because demand is relatively inelastic and supply is relatively elastic, you can see that 95 cents of the tax will be paid by buyers and only 5 cents of that dollar tax will be paid by sellers. Now let's look at an example when an excise tax is paid mainly by producers. We can create a market where the sellers will pay most of the tax. Notice here, the price rises just slightly to P2 from P1, just a small increase in price. But the sellers must then pay T dollars of tax, so the after-tax price sellers receive is nearly T dollars lower than the original price of P1. So if the demand curve is relatively elastic and the supply curve is relatively inelastic, then the sellers will pay the larger share of the excise tax. Here we can see that in the sale of parking spaces, where the original equilibrium price paid for a parking space is $6, and then the government imposes an excise tax of $5 per parking space. So now you see here that the buyers now pay $6.50 for a parking space, but sellers only receive $1.50 for each parking space. But with the demand curve being relatively elastic and the supply curve being relatively inelastic, most of that tax is paid by the sellers. The buyers end up paying 50% of the tax, and the sellers of the parking space end up paying $4.50 of the tax. So if the demand curve is relatively elastic and the supply curve is relatively inelastic, the sellers will pay the larger share of the excise tax. So when the price elasticity of demand is higher than the price elasticity of supply, an excise tax falls mainly on producers. When the price elasticity of supply is higher than the price elasticity of demand, an excise tax falls mainly on consumers. So elasticity, not who officially pays the tax, is what determines the incidence of an excise tax, or who bears the real burden of paying the tax. So taxes, like all things, come with benefits and costs. We will revisit the Smog City example to see the benefit of tax revenue and efficiency. After the gasoline tax in Smog City, the buyers are paying higher prices and sellers are receiving lower prices for the gasoline they exchange. However, the government is collecting tax revenue that can be used to help the city pay for roads, parks, and other services. How much are they collecting? We can see the revenue in the graph as the area of a rectangle. Here, we're looking at the price of hotel rooms, and we're assuming that before the tax is imposed, the price of a hotel room is $80, and 10,000 hotel rooms are sold out. But when the government imposes an excise tax of $40 per room, it creates a wedge in the amount of the tax between the sellers and the buyers. So now a room will sell for $100, but $60 will be received by the sellers of those hotel rooms. So how much tax revenue is being received by the government? It's the area of the green triangle. The wedge created between buyers and sellers of $40 multiplied by the reduced quantity of rooms sold, in this case $5,000. So if you multiply $5,000 by $40, then the excise tax will generate $200,000 in revenue for the government. So here is the general principle. The revenue collected by an excise tax is equal to the area of the rectangle whose height is the tax wedge between the supply and demand curves and whose width is the quantity transacted under the tax. This is something that you should be able to do. On the AP exam, you may be able to ask to calculate the amount of an excise tax. You may ask to be able to draw a graph like the one you just saw and to shade the area of the excise tax or that rectangle. So this is something you need to be able to do. So the tax revenue collected by the government is not a cost of the tax. It is a redistribution of surplus from consumers and producers to the government. So that surplus isn't lost because it's just transferred from consumers and producers to the government and used to provide government services. So that's not considered a loss. The true cost of the tax is the inefficiency that it creates in the form of deadweight loss. A fall in the price of a good generates a gain in consumer surplus. Similarly, a price increase causes a loss to consumers. So it's not surprising that in the case of an excise tax, the rise in the price paid by consumers causes a loss. Meanwhile, the fall in the price received by producers leads to a fall in producer surplus. So a tax reduces both the consumer surplus and the producer surplus, and this is what we refer to as deadweight loss. Now, remember the total surplus that was calculated at the beginning of this module, before the tax was imposed. Consumer surplus was equal to 1/2 times $3 times 1 million, or $1.5 million, and producer surplus was equal to 1/2 times $2 times 1 million, or $1 million. So total surplus was $2.5 million. But after the tax, what happens? Consumers, as you can see here in this graph, are now paying $2.60 rather than $2 for a gallon of gasoline, and they're only purchasing 800,000 gallons of gasoline rather than 1 million gallons of gasoline. So the new consumer surplus is equal to 1/2 times $2.40 times 800,000 gallons, or $960,000. Remember, it's the area above the price that they are paying going up to the demand curve, labeled here as CS. The new producer surplus is calculated because sellers are now receiving only $1.60 for those 800,000 gallons, so the new producer surplus is 1/2 times $1.60 times 800,000 gallons, or $640,000. Then we have to add to that consumer and producer surplus the area of government tax revenue, which is the area of the shaded rectangle, or $800,000. So consumer surplus of $960,000 plus producer surplus of $640,000 plus government revenue of $800,000 is equal to $2.4 million. But remember, total surplus before was $2.5 million. So we are missing $100,000. The money used to go to someone, but now it goes to no one. This is labeled here as DWL, or deadweight loss. The area of those two triangles that are lost to consumers, lost to producers, and lost to the government. Those are transactions that are mutually beneficial that no longer occur because of the tax. For example, there is a consumer out there who is willing to pay $2.50 for a gallon of gas, but no seller can afford to offer that gallon for sale. This is a transaction that goes unmade, and thus efficiency is lost. Of course, if the tax had not reduced the quantity of gasoline exchanged, due to a vertical demand curve perhaps, there would have been no deadweight loss. So this is what happens after the tax is imposed. We get deadweight loss equal to $100,000. And that is a number that you should be able to calculate or shade the area of deadweight loss on that graph. So we can see here that a tax reduces consumer surplus and producer surplus. Consumer surplus that is lost is the areas shaded A and B. Lost producer surplus because of the tax is areas shaded C and F. But the area of A and C is the excise tax revenue that goes to the government. So while A and C are lost to consumers and producers, they are not lost to society. But the areas shaded B and F are the areas that are lost to both consumers and producers and not received by the government. So the area shaded B and F is the area of deadweight loss. Loss to consumers, producers, government, and society. So although consumers and producers are hurt by the tax, the government does gain revenue and uses it for public purposes. The revenue the government collects, we've seen, is equal to the tax per unit sold, T, multiplied by the quantity sold, or QT. But a portion of the loss to producers and consumers from the tax is not offset by a gain to the government. And this is what we refer to as the deadweight loss caused by the tax. It represents the total surplus that is lost to society because of the tax. The deadweight loss is the amount of the surplus that would have been generated by transactions that were mutually beneficial to both parties that now do not take place because of the tax. Here again you see the shaded area of deadweight loss. The area between PC and PP is the amount of the excise tax multiplied by QT. That would be the area of government revenue. The area above PC up to the demand curve would be the new consumer surplus. The area below PP and down to the supply curve would be the area of new producer surplus. But you can see, even though consumer and producer surplus is lost, much of that is gained by the government. But the area of the shaded yellow triangle is the area of deadweight loss. Mutually beneficial transactions that are lost to society, to the government, and to consumers and producers. Now, using a triangle to measure deadweight loss is a technique that is used in many economic applications. So it's one that you should know by memory, by heart, and one that you should be able to draw and shade appropriately. You will probably have to do it on a test. You'll have to do it on the AP exam. When we get to market structure in a later unit, you'll find that deadweight loss triangles are used to measure loss that is produced by monopoly, another kind of market distortion. So you'll need to be able to draw it there. Deadweight loss triangles are also often used to evaluate the benefits and costs of public policies besides taxation, such as whether to impose stricter safety standards on a product. So it's very important for you to be able to understand the concept of deadweight loss, to be able to recognize it in a graph, and to be able to calculate it and shade it. Now, there is also a cost to collecting taxes, and we haven't talked about this much yet, but that is also a cost. There are administrative costs of a tax. These are the resources that are used by the government to collect the tax. They have to pay people to workers to work at the IRS. They have to pay for office space. They use land, labor, and capital. The government has to pay for this. So it costs the government something to actually collect the tax. And it costs taxpayers something to pay it, right? You may have to pay an accountant or a tax lawyer to do your taxes, or you spend time doing your taxes over and above the amount of the tax. Some people try to evade the tax and not pay the tax at all. So there are costs involved to society in actually collecting a tax. So the total inefficiency caused by a tax is the sum of its deadweight loss and its administrative costs. The general rule for economic policy is that, other things equal, a tax system imposed by a government should be designed to minimize the total inefficiency it imposes on society. So what have we learned in this module? Module 50 on efficiency and deadweight loss in the market. Well, we've learned about the concept of total producer surplus in a market. And we've seen that total surplus is the sum of the individual producer surpluses in a market, and that's equal to the area above the market supply curve but below the price. That's total producer surplus. But total surplus, the total gain to society from the production and consumption of a good, is the sum of consumer and producer surplus. Usually, markets are efficient, and they achieve the maximum total surplus on their own. But when excise taxes are imposed by the government, those are taxes that are levied on the purchase or sale of a good, such as a gallon of gasoline, or alcohol, or tobacco, or jewelry, or other products. And that raises the price paid by consumers and reduces the price received by producers, driving a wedge between the two, the buyer and the seller. The incidence of the tax, or who really pays the tax rather than who officially pays it, who bears the burden of the tax, is divided between consumers and producers, and it does not depend on who officially pays the tax. The incidence of an excise tax depends upon the price elasticities of both supply and demand. If the price elasticity of demand is higher than the price elasticity of supply, the tax falls mainly on producers. If the price elasticity of supply is higher than the price elasticity of demand, the tax falls mainly on consumers. Excise taxes cause inefficiency in the market in the form of deadweight loss because they discourage some mutually beneficial transactions from occurring. Taxes also cause a loss to society by imposing administrative costs, resources that are used to collect the tax. But an excise tax generates revenue for the government that it can use for public purposes. But it lowers total surplus. The loss in total surplus exceeds the tax revenue, resulting in a deadweight loss to society. So an efficient tax minimizes both the sum of the deadweight loss due to distorted incentives and the administrative costs of the tax. However, tax fairness or tax equity is also a goal of tax policy that needs to be considered. This ends our look at Module 50, Efficiency and Deadweight Loss.